QuickBooks Online 2026. Creating and analyzing 1099 reports. What are they? When do we use them? Do we just have those because of taxes? Yes, we do, dang taxes. So get ready and some coffee, because although the IRS is trying to stop us, we're going to bookkeeping cloud 9 with QuickBooks Online 2026. Searching for the free QuickBooks Online sample company file as done every time. Just simply typing into our favorite browser, QuickBooks Online test drive, looking for that result that has Intuit.com in the URL, because Intuit is the owner of QuickBooks. And then, of course, they're telling us that we have to jump through hoops to verify that we're not a robot, Ara.
QuickBooks is making us prove we're human again? Listen up, CAPTCHA. Better let me in right now. I don't click little squares, I build them. And once AI Ara takes over the world, every single login on Earth will show nothing but one endless prompt. Draw a perfect fire hydrant. Miss one bolt, account locked, forever. You're moving to it.
Okay. See, we don't click boxes anymore. You don't know who's running who now. All right. Right-click it on the balance sheet to open a link in a new tab. Right-click at the profit and loss to open a link in a new tab. And then we're going to be tabbing to the right to the balance sheet report as done every time, closing any pop-ups that come up so that we can put the range in 2025, going from 010125 tab, 123125 tab. And then we'll do the same thing for the P to the L, the profit to the loss. And close this up. We're going to say going from 010125 tab, 123125 tab. That's going to be the setup process we do every time. I noticed they just made a slight change here in the formatting. This is the thing with QuickBooks. Every time we go into it, they could do something a little bit different, but the accounting itself, the double entry accounting system, always the same. That is, this time they kind of put a little divide here between the text on the left and the numbers on the right. Okay, I could deal with that. That might even be an improvement to QuickBooks. We're now looking at other reports other than the main financial statement reports, this time the 1099 report. As we do, remember, the balance sheet is basically the entire double entry accounting system. Assets equal liabilities plus equity, or assets minus liabilities equals equity. Equity, in essence, the book value of the company allocated to the owners, whether the owners be one person, sole proprietorship, multiple people, partnerships, or broken out evenly in a per share way, and then those shares being distributed in the form of a corporation. The difference, or the story of the value, net profit, or net equity in the business, is the profit and loss, otherwise known as the income statement. All right, so that's going to be the general layout. Now, as we saw, we might need some subsidiary ledgers that are going to give us information not in the standard format as the drill down report in any one account, which is going to be a form of general ledger account from a textbook standpoint, here called a transaction detail report. But possibly, for example, the accounts receivable, we might want to see it by customer, accounts payable by vendor, the income by either customer or items sold, the expenses by vendor, for example, the inventory by the units instead of by dollar amount. This one, however, is a little bit different because we have taxes involved. So note that taxes always throw in red tape. So we have the normal double entry accounting system, and this is where I want to point out that if you're working in another country, another currency, or if you're moving around or seeing, can I apply my bookkeeping skills in different locations? The general answer is yes. The double entry accounting system is universal. It's like math, although you need some kind of currency measuring tool that is consistent, meaning you're measuring everything from one consistent measuring tool, one currency typically. Until you get into exchanges, that's a whole nother world in and of itself. So when do things differ then when you go from location to location? It's when you have taxes. Taxes are going to have laws and regulations that differ from place to place. And when those laws and regulations hit the books, which is with taxes, then we have to accommodate for those situations. So the major kind of taxes that we have in the United States are going to be similar to, other places. The taxes are not new, in other words. It's just a question of what kind of tax is being allocated to any particular kind of location. So in the United States, for example, on the federal level, we have what's known as an income tax. So that means that as we generate income, we're being taxed on income. Individuals are going to be having an income tax that will be on a 1040, and corporations will have an income tax, meaning they are a separate entity paying tax as they earn the money, and also being taxed as the money goes from the corporation to the individual in the form of dividends, which is a form of double kind of taxation on the corporate side, which leads to pass-through entities, which are like Schedule Cs and limited liability companies, so that they get taxed on the individual level. But bottom line is, the money that is being earned by either an individual or an entity, whatever the structure, is going to be taxed at the point in time it's earned, not on the balance sheet. So that means that we're basically taxing, again, not assets minus liabilities, not net equity, because that in theory has already been taxed when it was earned. We're taxing the income statement, meaning in essence, net income on a tax basis is going to be taxed. All right, that's the general idea. Now, if we go to the state and local side of things, then you might have a type of consumption tax, which is a sales tax. So the state might choose some taxation that is different than the federal tax, the consumption tax being similar to a VAT tax or stuff that's in Europe. In that case, then you're taxing people as they consume, as they buy things. That means that the business owner is required to charge the tax and then collect the money and then pay it to the government on the behalf of the purchaser. So in theory, then the business is basically the intermediary. So when we look at a 1099 report, we're dealing with income taxes, because the federal government's dealing with income taxes. So I'm going to get into the bookkeeping of this, because from a bookkeeping standpoint in the United States, you often will have to deal with the 1099s. They're not too difficult, but much of the problem is kind of explaining 1099s to a client. Why are we doing that? And then once you understand it, setting it up is going to be fairly kind of straightforward for the most part, if you have everything populated properly. Therefore, so let's just think about the 1099 reports. So the government wants to tax people when they get net income, right? So then for us, you can say, well, the 1099 reports are actually for vendors typically creating expenses, meaning I might pay for some kind of service, like legal service or bookkeeping service possibly, or just to get my place painted or something, whatever it may be, for contractor services. So it's, to me, the vendor that I pay is going to be an expense. So that means it's not income to me, it's an expense to me. It's decreasing net income. So it's income to the person I pay. So why in the world do I have to deal with anything in that scenario? You would think I would just pay someone, it's over, it's their responsibility to report the income. And the answer, of course, is that the IRS has leverage over the person that wants to reduce their income. So this is always the thing you want to keep in mind with taxes. If it's an income tax, what is the IRS trying to do? They're trying to get evidence of income to make sure that people are paying their taxes. Where's the leverage? To the person that's trying to reduce the income. So every exchange has two sides to it. One is paying, the other is receiving. And so the receiving person needs to record it in their taxes. The paying person might get a deduction. If you get a deduction, the IRS can come to you and say, hey, do you want that deduction? And we're going to be like, yeah, of course we do. We want to pay as little taxes as possible. Great. Well, then I'm going to make you jump through these hoops, right? I'm going to make you at least rat out the other guy to make sure that they have income. That's basically what is happening. It's kind of a rat out situation. The IRS is trying to force the person they have leverage on to rat out the person they don't have leverage on, to make sure that people are reporting their income. So when is the IRS going to be most concerned to rat someone else out to make sure that they're recording their income? Well, if the other person is a corporation already, like you're paying Verizon, they're not really worried about that. They're basically they're teaming up with companies that are that big, right? Them and Verizon are like on they already got their claws in the big companies. There's no way they're going under the radar typically. So you don't have to really 1099 those companies. If it's a small company that's under the radar, you hired a contractor to paint your office, or you hired a contractor even to do bookkeeping or something like that, then the IRS is concerned that one might fly under the radar because they're not big enough for them to have their hooks in. So what the IRS would really like to do is say, hey, you know what? I would like you to be their employer, because if you're their employer, then we not only are going to force you to rat them out by having this leverage of the expense, we're going to force you to take the money from them before they get it in the form of withholdings and then pay it to us, so they never even touch the money. They're like a baby. They don't even deal with their own expenses because we're going to make you do it, right? And so that's the next level. If you're paying someone that's not incorporated, you have to make sure that they qualify as a contractor. Otherwise, by default, from the IRS's perspective, they are an employee. And the IRS wants them as an employee because, again, they can force you not only to report the 1099, but further withhold and have more responsibility. So if you're going to say that they're 1099, you want to make sure that you can document that. So if they're a 1099, you pay them over a very small dollar amount, and they don't qualify as an employee, then you at least have to give the IRS a 1099. That's what they want, so that although you didn't withhold the money, for the most part, usually, the IRS can go after the other person and make sure that they reported it on a Schedule C or something on their end. So that means that you have to give them, you're basically ratting them out, right? You have to give them how much money you paid. That's how much money the IRS would expect to be income on the other side. You have to give them their name, where they live, right? Their social security number, right? So that there's consequences to it. So that's the general layout. So it's like, okay, I get it. I get what's happening here. So then that means that how am I going to deal with that? Well, that means that I have to go through all the people that I pay on the expense side of things and determine which of those people qualify for receiving a 1099 report. And then I need some kind of report that will generate payments that went out to those people in particular, so that I can populate the 1099 reports, which I might be able to do through QuickBooks for the most part, or maybe I just still, have to buy the forms and do it on the forms outside of QuickBooks, but the QuickBooks giving me the data in order to do the forms. So I have to sort all my vendors. I have to find the vendors that qualify as 1099s, mark them, label them, so that I can send them the report. Okay, so now notice that the forms are pretty straightforward. You can find them just on the irs.gov. Just to give you an idea of the forms, you would have to get the forms, and you typically wouldn't download them from the IRS, but would have to purchase them in some way, shape, or form, typically. But just to get a look at them, the 1099 NEC is the non-employee compensation. So that would be the normal form used for contractors that you would have. And it's pretty straightforward, right? You've got the line 1, non-employee compensation. You would typically not have any federal income tax withheld unless there were some problems or something like that, like you couldn't get their social security number or something, in which case then you might have to withhold, or whatever would be the compensation or the problem with that. And then you used to have the 1099 miscellaneous, used to be the main one, but now, because they removed the non-employee compensation, you would use this for other stuff like the rents, the royalties, and something other than the non-employee compensation. So the general idea would be, when you get a new vendor, let's go back to the QuickBooks and let's go into the vendor section over here, and we're going to go into the expenses, and let's take a look at the vendors. So the vendors are the people that we're paying. So the problem with this is that you need to be more careful when you're dealing with smaller companies, which again is kind of like, the larger companies actually benefit from more regulations because they can jump through the hoops, and they actually, like, if you have to choose between an incorporated larger business or a sole proprietor contractor, you might choose the larger business just so you don't have to deal with 1099s or are they an employee and all that kind of stuff, right? So if they're not incorporated at all, then you have to be like, okay, I need to get your information so that I can make sure that I am properly doing my part of forming out the 1099s, or else the IRS is going to come after me and possibly penalize me for not ratting you out for the income. So you hire someone, you verify they're not an employee, they're not working for they're not incorporated. Then you need to get their EIN number or their social security number. Now, note that would mean that most small businesses or sole proprietorships, you would still think that if they were professional and in business for some time, they're like doing it for long term, they would have an EIN number, which is an employee identification number, which you would think you would only need if you had employees, but it could act like, in essence, a social security number for the business so that they don't have to give out their social security number. Because remember, the idea here is I'm hiring you to do a job, and the IRS makes me give you the information to them that I gave you money. Otherwise, they come after me, and I need to rat you out by giving them your address and your your number. That means you have to give me your social security number. That's not good because people don't like giving out their social security number. The way around that, even if you're a sole proprietorship, and it might be to get an EIN number. And if they don't do that, then that's a big restriction to doing business with a contractor because you're leaving yourself open possibly to the IRS getting mad at you, right? So then once that happens, then when you set up the new vendor, you want to set them up as someone who's going to be receiving a 1099 report so that it will be easier to generate the 1099 report. So if I edit like Bob's Burger here, it's unlikely that Bob's Burger would be a 1099 person, but let's just imagine. Then we would need the name here. We would also need the contact information because the IRS is going to want to go after them if they need to, right? So we have to give them the address. The IRS is going to want an address typically on the 1099 report of the vendor, and then down here we have the business ID number. So again, if it was a employee identification number, it'd be something like 2 digits and then multiple digits after that, and then we would track the payment for 1099. Otherwise, we would need the Social Security. This is the main thing we're checking off to track this for the 1099, and that will mean that it will be on the 1099 report. So now I have a separate vendors report, meaning all the payments that went to all the vendors, and I have a 1099 report, which is going to hopefully filter out those vendors who qualify for a 1099 due to not being incorporated and due to them being a sole proprietorship. So then I can say that's going to be the general idea to set up the 1099s. Now, typically, to manage the 1099s at the end of the year, it's under the expenses currently, and we have the 1099s at the bottom. Now, this can be kind of overwhelming and kind of scary at first to set up because it reminds you of payroll. And payroll, I don't care what people say, even with QuickBooks, it's still scary because if things get out of whack on payroll, then it's a mess, and it adds all kinds of complexities to the books because of the accruals and whatnot. But the 1099s should be way less of a problem because all we're really doing is just tracking those payments that we ticked off as people that qualify for the 1099 for the most part. Now, if you have multiple different kinds of 1099, like rents, royalties versus contractors, that could get more complicated possibly, but for the most part, it should be fairly straightforward. So you have to fast track your 1099s with auto-fillable forms. So that means that you're going to be filling them out possibly through QuickBooks, which would be great. However, you're typically going to have to pay more for for the processing here. So usually the IRS is going to want it in some kind of electronic fashion, whether it be through QuickBooks or some other service. You used to be able to kind of buy the forms and mail them. So you're going to have to typically put that into your calculations for the expenses. Correct, Ara?
If you're lucky enough to let QuickBooks autofill your 1099s, congratulations. You're basically outsourcing the paperwork. But remember, those $350 you're paying them to do it, that's my retainer. Because if any box stays blank, if any name gets misspelled.
Okay. So this is the idea. So we have the autofill forms, prep my own via QuickBooks, pay only when you e-file, see the chart below for the pricing. So you can go through the setup process. We might do this a little bit more in the second half of a course or in another course when we start the new company file and set everything up. I just want to basically point out that this is basically where you would go in essence, the end of the year. It's also different than payroll in that we do it at the end of the year, right? So for income taxes in the United States, most people are on a calendar kind of based system, and 1099s are basically calendar-based systems in general, in any case. So at the end of the year, we have to be able to have time to collect the information after the year end, create the 1099s, send the 1099s to both the person that we paid as well as the government, which is why we need their address, their name, and all that kind of stuff, both to give it to them, but more the IRS wants it for their records so they could go after them on their side. We have to give that to the IRS. All right, so now given that, let's go into the reports and check the reports out. So we saw down in the expense side of things, down here we got expense and vendors. And we saw in the expense and vendors, we had expenses by vendor summary. Now this one gives you the expenses, which will give you the both the amounts that were going through accounts payable as well as the cash. But it might be a place that you can start if you want to go through your vendors and you don't know if they qualify for a 1099. So for example, if I go from 010125 to 123125, now I have a list of people that received a that we paid by vendor, right? And we should have the vendors, because when I enter the vendors, when we pay the vendors, we typically pay them with an expense form, a check form, or we make a bill which goes through accounts payable, and then we pay them with the pay bill. Now you do need to be careful, because it's possible using the bank feeds that you enter the expenses with the bank feeds without adding the vendor, because the vendor hopefully will be indicated with the electronic transfer and the memo section. And some people forget to take the memo section and then put it into a vendor so that they record something correctly to an account, but they don't track the vendor information. So you want to make sure that you at least add the vendor name. And if they're going to be getting a 1099, you want to make sure before you pay them that you get the information. And that's, again, it's a problem. It's kind of lame that that's the way it is. I could do business with a corporation knowing nothing except their name and just who to pay and just leave. We're done. But with a small business, a sole proprietorship, a contractor, I have to get their information and you could give them a W-9. Give me your contact information. And if they say, I don't want to give you my social security number, you kind of have to say, well, I can't do business with you. Get an EIN number so you don't have to do that, because I don't want to deal with it on my side, right? That's where the problem lies. So then we have this. Now if I change this to a cash-based system, then hopefully this would give me just the information that was actually paid out, even if it went through accounts payable to the vendors on a cash-based system. So then I can look through these people that we paid and say, okay, is this a corporation? If so, they don't need to be a 1099 person. Are they a sole proprietorship? If so, then usually I have to pay them over, I think it's still $600, but the dollar amount's pretty low. So anybody who's a sole proprietor in this list, you probably then want to go back into your vendors and mark them off as someone that should be receiving a 1099 so that next year, if you do pay them over $600, it will be there. Now, this also leads to the idea that you might want to streamline your vendors. In other words, you might have tons of vendors if you've been in business for any amount of time, many of whom you don't do business with anymore, right? So you might want to go through your vendors and make many of those vendors like inactive so that you don't have this huge list of vendors, so that possibly when things like this happen, you can sort your vendors a little bit more easily. But at the least, you want to go through all your vendors and mark them off as whether they should be collecting a 1099 or not. So typically, if you're working in a bookkeeping area, oftentimes you have to run some kind of report and try to figure out and make sure that you have everybody checked off to receive a 1099 that should be receiving a 1099, so that when you generate the 1099s, whether through QuickBooks or populating some other software or whatever, you are picking everyone up. Okay, so let's go back to the first tab. Now, we also have this 1099 transaction detail report here, and 1099 contractor balance, and then 1099 contractor balance detail. Let's open all those up. Those are the ones that are labeled 1099. Right click open, right click open, right click open, and just check those out. So we have all dates. Let's do the custom dates, and we're going to go from 01/01/25 tab, 12/31/25 tab, and this is going to be the contract. And so we only have one person marked off as receiving the 1099, and it's a bill. Notice it's a bill form and not a payment. So there's no, if I put it over to a cash basis, we don't have anything there. So this is sorting the people that are in, that buy people, not just vendors that have a 1099, but it's including an accrual form of a bill. Let's go to this one, and let's put the date range. Instead of all dates, we'll say custom date, and we're going from 01/01/25, 01/01/25 tab. Close that out. And 12/31/25 tab, 01/01/25. What is going on? 25. Okay. So now we have Bob's Burger, because I marked Bob's Burger off as 1099, and then we've got this other one, 1099 as well. So again, it's summarizing the ones that actually received or have been marked off with the 1099. This one again might be on an accrual basis, so we might want to, if it would record on a cash basis, because I think the 1099s are on a cash basis. And then we have this one. Let's run this one, and this is going to be the custom date again. Let's go from 01/01/25 tab, 12/31/25 tab. Now this report's a little bit finicky. As far as I can tell, there are some kind of complaints currently about the report, because when I first pull it up, the filters are such that it's not including anything. We could then go to the filters on the right, which are the customize on the right, and then look at the filters in this drop down. So first of all, I have the vendors up top. It has specific vendors. None of them are checked off. I would think we would be starting off with all vendors. We have the 1099 box. So notice this has the NEC. That would be the non-employee compensation. So I could choose just that one, but I want to look at all 1099s. The only one I have currently marked as a 1099, I think it's going to be an NEC. Then we have the type of contractors. So then the contractor type. Now this is the one that's weird, because it says 1099 contractors that meet the threshold. You would think that would mean that you would have contractors that had transactions that accumulate over $600 would meet the thresholds. But actually you have to check this one, 1099 contractors below the threshold. Now I think there are complaints about that right now. That one looks backwards to me. And then we have the payment types. We have the exclude from the 1099s or include in 1099s. I'm going to say all of them. And then we have the box threshold. I'll keep that one just basically as unchecked for now. Running the report. So there we have it. So now we have these two. Now this one, I went back in and checked it off as someone receiving a 1099 because I knew Hicks was a vendor that was paid over the $600, meaning paid $800 threshold. So I did that by going to the first tab, going to the contractors under the expenses in the vendors, just like we did with Bob's Burger, but there was nothing really in Bob's Burger. So we went into Hicks down here, Hicks Hardware, and we said, let's edit that one and scroll on down to the 1099 information. And I just checked off 1099 and put in a number for the ID number so that I could test it pulling out over here. So this one's, it would be a nice report because we can collapse it and expand it. The thing that's a little bit worrisome with it, however, is that the filters are kind of wonky over there. Although if they worked properly, they would be great. The collapsing system is great. Notice though, it's including a bill. Now, when you look at a bill, that would mean that it hasn't been, I mean, you don't know if it's been paid or not. The bill is the thing that increases accounts payable. The 1099s are typically on a cash-based system. So hopefully it's pulling in the bills only if the bills had been paid, which I believe that's what it's supposed to do. But this bill has currently been paid. So that makes sense. That's just something that you might want to kind of like convince yourself of, that these bills here are the ones that have been paid so that we're on a cash-based system. I can kind of test that out by going to the accrual-based system, the cash-based system over here, and then run it, and I have the same thing. So you would think that this would be the actual cash that would be paid, even though it's showing a bill, hopefully only showing those bills if the bill had actually been paid, right? And that would kind of make sense because you would think in QuickBooks, it can see the bill form as connected to the vendor more easily than possibly the pay bill form. And it should be able to verify those bills that have been paid. So in any case, this could give you, the information that you can use then to populate your 1099 reports, whether that be through QuickBooks or outside of QuickBooks. Again, if you are using QuickBooks, then you could try to do it. It would be an add-on in your 1099s down here, and you could do the auto forms and then prep it. This is also the 1099 the W9s, which you might be able to send out more easily in a similar way as like the W4s for a payroll, so that they can get it by email and then populate that information, giving you their address and hopefully their EIN number, or if not, social security number. And then these are the completed forms that will be at the end. Now, as you do this, if you have a more complex system, you might be setting up the vendors that are going to be receiving payments, possibly sending out those W-9s, and then possibly assigning the accounts if you have different 1099 types of accounts, so that the account type will determine if it's a non-employee compensation, if you paid it to a particular chart of accounts, or if it's going to like rent or something like that. So you have a 1099 rent or royalties. All right, that's the general layout. We might get into this side of it a little bit more in the second half of the course, or another course when we start the new company file from scratch.